The impact of interest rates on stock prices. Here are the lessons to be learned from this blog. 1. Interest rates and borrowing costs. Higher interest rates increase borrowing costs for businesses, potentially slowing expansion and reducing future earnings, which can negatively impact stock prices. 2. Discounting future earnings. In valuation models, higher interest rates raise the discount rate applied to future cash flows, thereby decreasing the present value of these earnings and exerting downward pressure on stock prices. 3. Consumer spending and investment. Elevated interest rates can dampen consumer spending and business investments due to higher borrowing costs, leading to reduced corporate revenues and potentially lower stock valuations. 4. Monetary policy influence. Central banks, such as the Bangko Sentral ng Pilipinas (BSP), adjust policy rates to manage economic factors like inflation and growth, directly influencing market interest rates and, consequently, stock market performance. 5. Foreign investment flows. Changes in local interest rates can attract or deter foreign investors seeking favorable returns, affecting currency strength and stock market dynamics. Understanding interest rates and their role in financial markets. Interest rates represent the cost of borrowing money and the return on savings, determined by central banks like the Bangko Sentral ng Pilipinas (BSP). They influence the entire financial system, affecting consumer spending, business investments, and asset prices, including stocks. In the Philippines, interest rates fall into two categories: policy rates, set by the BSP to regulate inflation and economic growth, and market rates, reflecting broader market sentiment. These rates shape investor decisions by influencing liquidity, capital costs, and financial stability. Understanding their role is essential for investors looking to navigate market fluctuations effectively and manage risks. How interest rates affect stock prices. Interest rates impact stock prices through borrowing costs, discounting future earnings, and consumer behavior. Higher rates make borrowing expensive, discouraging business expansion and slowing earnings growth, which can depress stock prices. They also raise discount rates, reducing the present value of future cash flows, making stocks less attractive. Additionally, rising rates dampen consumer spending, weakening corporate revenues and stock performance. Conversely, lower rates promote growth by making financing cheaper, increasing consumer spending, and boosting valuations. These interconnected mechanisms drive market fluctuations, making interest rate movements a critical factor in shaping investment strategies and market behavior. Interest rates and the Philippine stock market. The BSP's monetary policy directly influences stock prices in the Philippines by adjusting interest rates based on inflation, economic growth, and external conditions. During periods of high inflation, the BSP raises rates to stabilize prices, often triggering market corrections. In contrast, rate cuts stimulate borrowing and spending, leading to bullish trends. Foreign investment is also affected. Higher local rates attract foreign capital, strengthening the peso and supporting stocks, while lower rates can prompt capital outflows, weakening the market. Understanding these dynamics helps investors anticipate market shifts and position their portfolios accordingly in the Philippine economic landscape. Historical trends and market behavior in the Philippines. Examining past interest rate movements reveals clear patterns in the Philippine Stock Exchange (PSE). Rate hikes aimed at controlling inflation typically result in market volatility as businesses face higher borrowing costs. Conversely, easing monetary policies, such as those implemented during the COVID-19 pandemic, improve liquidity and drive stock prices higher despite economic uncertainty. Investors must analyze these historical trends to anticipate potential market responses to BSP policies. By studying past market behavior, Filipino investors can gain insights into how interest rates shape stock valuations, and use this knowledge to refine their investment strategies. Investment strategies for interest rate changes. Filipino investors can mitigate risks by monitoring BSP announcements, diversifying across sectors, and focusing on fundamentally strong businesses, rate-sensitive industries, such as banking and real estate. React differently to rate changes, making diversification essential. Dividend-paying stocks provide stability during uncertain times, while agile portfolio adjustments help investors capitalize on market shifts. Understanding inflation trends and foreign capital movements enhances decision-making. By staying informed, adapting to economic conditions, and maintaining a long-term perspective, investors can navigate interest rate fluctuations effectively, turning market uncertainties into opportunities for growth and financial success in the Philippine stock market.